60 minutes, we're going to tell you and teach you the truth about 9 questions you have to be able to answer to have a secure retirement. Stock market returns and your beautiful pie chart. The stock market risk and how it ultimately can affect your future. The total fees you pay, both direct and hidden. Safe income withdrawal rates. How you can actually control your money. Allocating assets for retirement success. Reducing risk and creating dependable lifetime income. How to design a comprehensive written retirement income plan. And then planning for your future and how you can actually have a secure retirement. Let's get started. As I said before, it's your money. It's time you heard the truth. So, do you own what we call a beautiful pie chart portfolio? Isn't that a beautiful pie chart? Don't you kind of get that when you get your statements? You get this wonderful portfolio and it has all these different 20 or 30 or 40 funds and it looks wonderful. And you don't understand it, but it looks beautiful. And you've been told that you're diversified. You don't have a lot of risk because you have all these mutual funds and they're a lot less risky than stocks. You don't lose a lot when the market goes down. You'll earn a good rate of return and you're only paying 1% in fees. Doesn't it all sound wonderful? What if a lot or all that you've been told isn't true? Okay. What if it's not true? But it's still a beautiful pie chart, isn't it? So you still have a really beautiful pie chart. This is a chart of the S&P 500 from 2000 through 2018. It's a 19-year time period. So this is where you've invested money. And you think that's a crazy question because you don't think you can make your money act in a certain way because you've been told, don't watch it, you can't control it, everything will work out in the long run. Always ride it out, which means you can't control it. Well, you've been told 2 myths. The myths are, 1, you should always ride out all market corrections. And if you do so, you're going to get a 10% or higher rate of return. So this is the S&P 500. If in January 2000, the market started at 1469, that's the S&P 500, which is the 500 of the largest companies in the United States. Okay? We're at 1469. Then in 2001 and 2, we had the technology bubble. We went down, then we got back up, went down in 2008, went back up. Well, in December 2018, the market ended at 2506. So look at that growth rate we got if you did what? If you rode it out, if you didn't get out, if you weren't chicken, if you never bailed. That's what they tell you. The problem is that's a 2.85% annual compounded increase for all the pain and suffering you went through. Is that worth it? The answer is no, it's not worth it. You would have earned more in CDs during that time period. 2.85% before fees is not worth what you went through. The market started at 1469. The market ended at 2506. Has anyone ever told you that over that 19-year time period, the market went up by 2.85%? No, because if they would have told you that, what wouldn't you have done? You would not have invested your money. You would have not have given them your money. Okay? Now, why did it work this way? We'll prove it to you. Remember 2001 and 2 when the market lost 50%? When the market goes down 50%, a lot of people think, well, I only need a 50% gain to get back to even. Is that true? Mathematically? No, when the market goes down 50%, you need a 100% rate of return just to get back up to even. Not to make any money, just to get back up to even. Now, how easy is it to make a 100% rate of return? Not that easy, but it happened. And at this point, if you can imagine, you got back up to even, and at that point, how did you feel? Didn't you feel relieved? Didn't you feel elated that you finally were back to even? Didn't you feel happy that you made 0% over 7 years? Which is what happened, right? That's what happened. Then you thought the market would continue to go up, but then we had the 2008 financial crisis when the market fell 53.8%, so I rounded it to 50%. You needed another 100% gain by January of 2013 to break even. So how would you like to make nothing for 13 years minus your fees? Which is what you did. Why do you think you made money over that 13-year time period if you were working? Why? What's the only reason why your account continued to grow during that time period? Anybody know? You kept contributing monies. That was the growth of your entire account. You kept putting money in, because guess what? All of our clients are really good savers. So as a good saver, are you going to stop saving money? No. So that's what created the growth of your money during the time period, because this 2.85% needs to be reduced for fees. And the only growth you had was whatever that net was, plus whatever you added to your contributions. Okay? That's why your account grew. So if we have an asset that's behaving with that much volatility, can we plan, take consistent income, and during retirement, can you feel secure if that's what's happening? And the answer is no. You're told you're supposed to. You can't believe that anymore. It's just not true. So if we look at the S&P 500 and we're up here, what do you think the market's going to do? At some point, not necessarily right now, but at some point, this looks like where we were here before it crashed, here before we crashed. It's going to come down. We don't know when, but it will come down. And I'll show you why in a second. So this became one of our big slides out of a book we wrote called Don't Bet the Farm. This is the S&P 500 from 1999 to 2013. It's 15 years. And when you look at it, if you start at $1 million and you go through all the volatility, you write it out, you end up with 1.5 million. That sounds pretty good. You have 50% gain over 15 years. It sounds to the average consumer that that's really good. The problem is if you rode everything out and you never took your money out, it looks like you made money. That's a 2.75% average compounded rate of return for 15 years before fees. Is that a good rate of return? It's terrible. You can say it, it's terrible. And no one's ever given you this data before because they don't want you to know this is what happened in the market. Okay? Now, why did it happen? Well, if you look at this time period from 2000 to 2013, remember that 13-year time period? If you're here and the market goes there, what did you make? Zero. Other than your account grew because you kept putting money in as a good saver. Right? As a good saver, you kept putting money. That's what made your account grow. So why? Well, in 1999, the market went up by almost 20%, and you thought it was going to keep going up, right? But then we had the 2001 and 2 technology bubble where the stock market dropped 50%. If you're in technology, you could have lost 70 to 80% in technology stocks, okay? So we crashed. Then we came back up, thank goodness, but then we crashed again, okay? Now, if this happens, can you take a significant amount of income out of your assets as long as you live if your assets are behaving with that much volatility? It's mathematically impossible. It's just mathematically impossible. No matter who you are, you can't do it. Okay? So why did we discuss this? Because this is what's happened since 1996. So remember, that's one 15-year time period, 99 to 2013. How about 1996 to 2010? The market went up 5.12%, 3.82, 2.83 for the next 15 years. That's the time period we studied. We looked at all of the last 9 15-year time periods, and the average rate of return as far as compounded before fees was 4.17%. Is that worth all the risk we took? And the answer is no, it wasn't. This is the key. These are all the bear markets since 1929. Investors have lost an average, or the stock market has gone down an average of 39.5%. This is 1929 all the way through the last big one, which was the 08 financial crisis. So the good news is, since 1929, there's only been 13. So that doesn't sound that bad, right? The problem is mathematically, what does it mean? That means it happens every 7 years. So if it happens every 7 years, and right now we are 10 years into this bull market, what does it mean? You know what it means, right? Everyone hears the ticking clock. Tick, 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 tick. We're 3 years overdue. Okay? I always believe in history. Here's the key. If you suffer a 35% portfolio loss, you only have a 61.1% chance of getting back to even over any 5-year time period throughout history, which means you have a 39.9% chance not only will you not get back up to even, you won't even make any money. Does that seem fair? But that's how it works. Okay? And during retirement, we don't have 5 years just to hope we're going to get back to even. You just don't.